All right, I guess it's the mid-2000s, Brian Sozzi. Everybody loves the bank stocks, including the team over at Goldman Sachs.
Yeah, buy, buy, buy. Well, at least that is the mood off of a pretty bullish Goldman Sachs note this morning, guys. And the team really calls to three things here. Why they're bullish. First, on the first quarter earnings season for banks, which kicks off in a couple weeks. First, large reserve releases. You know, the Goldman team sees banks reserve releases totaling $5.6 billion in the first quarter. So what does it actually mean? With the economy improving a lot faster than the banks would have thought, that means they need to set aside less money on their balance sheets, and that money will be released. And it could be what Goldman thinks could serve up a 15% boost to first quarter earnings for some of the major banks. That could be a pretty big windfall. Number two, slowing net interest margin pressure, in large part because of the rise in yields. Now Goldman's not looking for year-over-year net interest margin improvement in the first quarter. That's more towards the back half of the year, but more sequential improvement, and that might be well received by the market, Goldman says. And last but not least, continued strength in fees, within the investment banking division. It's not just investment banking. Certainly, we've seen a lot of activity. We've still seen mergers and acquisitions going off at a nice clip. We've seen a lot of SPAC activity, but also trading. I mean, a lot of these big banks have saw a bonanza in first quarter trading amid the rise in retail investors, and that should be good. Also worth noting, too, more so in the back half of the year, Goldman looking for a big buyback boom within the banks. And I think that's somewhat reflected in these bank stocks. You have the KBW Bank ETF for about 25% year to date. But Goldman looking for $83 billion in stock buybacks within the major banks this year. That equals about 6% of their market cap. Next year, that's going to be over $101 billion, Goldman Sachs says. So Goldman very out bullish here on the banks, most notably Morgan Stanley, Citigroup, and Bank of America. And Julie, I didn't want to just make this about Goldman Sachs. Deutsche Bank also calling for a 30% to 50% increase in bank stocks over the next 2 to 3 years. So you're now seeing double-barreled bullishness here by Deutsche Bank and Goldman Sachs.
Yeah, I mean, that would be quite a rally. I keep thinking about, though, what we talked about with JJ at the beginning of the show, that the folks on the TD Ameritrade platform lightened up on some of the big banks in the past month or so. So I thought that was quite an interesting sort of counterpoint to what we are seeing in terms of a lot of the bullish rhetoric we're getting from the street. You also have to wonder, if we do not see yields go up significantly, if that is going to be a bit of a break, if you will, on that big growth that a lot of these folks are expecting for the banks.
I think what I'm looking for in this trend over the next 5 years is we're going to start hearing about repairing the gaps in some of these charts going back to the financial crisis. If you go back in time, 10, 15 years, you look at the chart of Citi, for example. I'm just pulling up the chart of Bank of America. Look at that one on its max scale. You got a lot of headroom there to get back to those record highs. And I think we're going to maybe hear about some of that as we get into this kind of, steeper yield curve, faster growth, accommodative Fed type environment that it certainly seems everybody is betting that we are not just entering right now, but we'll be in for some time in the years ahead. So I think a good one to watch out for there. And as we all know, Jared Blickery can certainly tell us, when stocks retake highs after trading below them for 10 or 15 years,